Microphone. We're called to order. This is the meeting of the Oklahoma City Post-Employment Benefits Trust. It's called a special meeting because we did not meet at the normal time, so we're special today. Do you all feel special?
I feel special.
Oh, excellent. Excellent. Okay, our first item on the agenda today is to approve the minutes of the meeting for August 13th of 2018. If they're all in favor?
Aye.
Any opposed? Motion carries. Second item is presentation of actuarial valuation for fiscal year ending June 30th, 2018. Randy Gomez with Nyhart is here to make a presentation, I believe. Randy, is that a surprise to you? Is it a surprise to you that you're making a presentation this morning?
No, it's not.
Okay, good. Good. Well, welcome to the podium.
No, thank you for the opportunity to present. Glad to do that. I enjoy not so much presenting, I think of it as teaching. So hopefully I'll take a few minutes to kind of walk through what the activity that's been going through the trust and maybe give you some ideas for planning for going forward. So what we have today can be sustainable, or is sustainable. So you, in your packets, you should have a copy of our actual report for the year ending 18. The key page in that entire report is page 5. I'll give you a minute to look at it if you want to. Page 5 presents the activity from the beginning of the year to the end of the year for the liabilities as well as the assets. Let's just talk about the assets. It's a little bit easier to understand. The city has made available to its employees retiree health care. You work long enough and you fill out the paperwork, we'll let you continue coverage with the city. You pay half, or eventually 50% of the premium. Today it's 48. Then the city will pay the other half of the premium. Okay? There's a lot of money involved. Your half of the city's half of the 50% of those benefits amounted to just under $11 million. Okay? So for this year, you're obligated for $11 million. Next year, it'll probably go up as more people retire, as you have health care inflation. In addition to that, money going out, leaving was $11 million. Money coming in to pay for that was enough to cover that, plus an extra $3.6, $3.4 million on top of that. The city's making or has a plan to pre-fund future expenses. It's to your benefit to do that. The more, the better. But for every dollar that you put in, and you can earn more investment income on it now, that'll be less money you pay down the road. So there's a very clear economic and financial incentive for doing that. The key question for you, not just you, but everybody else in that same situation, is how much more can you put into it? Okay, how much more than just enough to cover the cost? If you're looking at page 5, what I'm looking at is a line item under the labeled contributions employer of $14.5 million. That's how much money the city, from whatever pockets of revenue or sources of revenue you have, that actually was deposited into the trust. From my perspective, I don't care where it comes from. Come from different reserves or for taxes. It's just money going in that I look at. There's a little bit of money for running the trust. There's advisors that have to be paid, bank fees, that kind of stuff, pretty minor stuff. But as of the end of your fiscal year ending June 30th, you sat on about $58 million in cash. Okay? That's pretty good. The beginning of the year, you were at 48. You had a good year asset-wise, a little more than 10% on a market value rate of return. That's the easy part. Let's talk about the liabilities. It's a little more complicated, but I think I can. I'll do my best to communicate what's happened. So, if you make a promise to somebody, say, I will pay for half of your insurance bills, retiree medical bill. Okay, for financial purposes, that promise has a value. Okay, that value represents what you're going to pay this year, next year, the year after that, and the year after that. So it's until that person is expected to die. And not just for the people who are retired. There's also a value for that for people who are working today who have an expectation, if they work long enough, they will retire and receive a similar benefit. So the value of that benefit includes retired and actives, as well as any spouses of these retirees. At the beginning of the year, on page 5, the liability for all these people under our modeling assumptions, actuarial assumptions, was $570 million. It's a big number. It's a really big number. You have a lot of people, okay? The more people in the pool, the bigger the number. Other things that make that a really big number are things that you don't really necessarily control. It's healthcare inflation. In my numbers, I build in that next year's premiums will go up by 8.5%. The year after that, 8. The year after that, 7.5. And I gradually bring it down to 4.5. At the beginning of the year, you were at 5.7. At the end of the year, when we get fresh data and we remeasure everything, that number had dropped to $478 million. And I'm going to tell you what's happened. You had a bit of good news. Some of that you made happen. Some of that you didn't have a lot of control over. The good news that you do control is that your health care costs were lower than what they increased, but less than what we were expecting. So if you're expecting costs to go up by 10%, but they only go up 4%, hey, that's good news. That's a gain from my perspective. Your costs are higher, but not as much as you thought they were. You got credit for that. That pushed down the $570 million. We also are giving you credit because we're recognizing more directly that you have a cheaper alternative medical option. You have a health care plan called the alternate indemnity plan, okay? You have a lot more people actually enrolling in that plan now than you did a few years ago. And we thought it needs to be reflected in our numbers. So we gave you credit for that. It turned out to be a pretty nice little decrease in the liabilities. The other place that you're getting credit for, and it helped quite a bit, is there is an underlying bond index that I need to reflect or consider when I do my calculations. And I'll get into that a little bit. But at a high level, you have money, $58 million, okay, in a trust. And you have hired advisors, experts in what they're doing, and over the long term, we think we can earn 7.5% of that money. Great. I'm all for it. I support it. But the money going in, the policies that you've put in place, the financial restraints the city has, can't keep up with the money going out. So eventually, that $58 million will be depleted. Okay? It doesn't mean that you can't offer retiree health care insurance anymore. It just means you don't have a trust that is able to pick up some of that expense. You just have to pay for it out of your general fund. Because we're projecting that the trust will be depleted, I have to blend your asset return with a lower bond index. So all that explanation is this. From the beginning to the end of the year, the bond indexes have gone up. So as those rates go up, I give you credit for that. Your policy has not changed in terms of what you can put in. Okay? But just the underlying outside independent statistics is benefiting you. I do want to advise you it's benefiting you this year, but it could hurt you next year. There are no guarantees in which direction that bond index will go. Smarter people than me maybe can tell you which direction it's going, but I don't claim to be an expert in that area.
Randy, I have a question.
Yes.
The city also implemented a Medicare Advantage plan.
That was a good decision.
Okay, and so was that factored into
Yes.
your analysis? Okay.
Yes, we were aware of that, and you've been doing that for a few years, I think.
Actually, we just implemented that in I think it was January of 2018. I think we just implemented that this year. Yeah. Yes.
Okay.
So that Medicare Advantage plan, and we saw significant movement with our open enrollment that just occurred in October. So.
October of 18?
Yes.
Okay, that would have been too late for me to.
Well, no, I mean for next year. That's what
yes,
for plan year 2009.
So it's not that particular open enrollment period is not reflected in my numbers, but it will be in the next one. So if you have 1,000 people, or actually you have almost 2,000 retirees, it's a big number. If these retirees have an option of multiple plans to pick from, and there's a big movement from expensive plan to inexpensive plan, that's a lot of credit. Okay, and you'll get it, but not until I do my next renewal.
You did take into consideration, since we implemented that plan in January of 2018, this report will reflect any movement that occurred between January and June. Because this is as of June 30 of 2018.
Let me confirm that. I think
Okay.
I think the answer is yes. There's in our report. Got these out of order. Sorry. Here we go. On page 29 of our report, at the bottom of page 29, we disclose the options that we are valuing as we know them. Okay? If that option's in there, and if the data that was provided to us has people enrolled in those cheaper plans, you're getting credit. Okay? The other thing that you have done, the city has done, I think was a good move, is you have said new hires after January 1, 17 will no longer get an explicit subsidy for benefits. That's a good move long term. You don't get a lot of bang for that change short term, but eventually, 10 years from now, I'll be able to demonstrate, hey, you saved millions of dollars by making this change. Okay? The reason it's not a big bang right now is because I can't give you credit for people you haven't hired yet. Any questions on what I have said so far? Okay. I had some other notes I wanted to address here. So going forward, where I wanted to focus your attention is you have a trust, you have a growing larger pot of money into it. At some point, it's to your best benefit is to have a focused, dedicated plan. What's the plan here? When do I get the benefit of having this money? At which point can I slow down paying for insurance from my general fund and tap into all this investment income? Okay? How long is my 7.5% interest rate sustainable? And do some sensitivity testing. That kind of long-range planning is helpful because it will avoid surprises down the road. The other thing I wanted to kind of point out, I think the city is doing a very good job of managing its benefits. You, from time to time, do look at networks, plans, expenses, so that you're doing the right thing. Maybe you don't get enough credit for it, but my advice is don't get lazy and do the same thing over and over. Pay attention to it. That's the highlights of what I was going to talk about. If anybody has questions, I'm glad to provide follow-up questions later on, too.
Are there any questions for Randy? Well,
sorry, I did have one other thing I forgot. In our report, there's a section in there where we give you a recommendation. If you had the ability to do the full funding as recommended by the actuary, we would say put in $21 million. Okay? And if you did it every day going forward, not just this time, then it would allow me to recognize the full credit that you're deserving of 7.5% interest rate. If you put in enough money on a regular basis and have a plan that's sustainable, you get credit for that. That would really reduce your liabilities a lot more. Does that make sense? Mm-hmm. Okay. All right.
Are there any questions for Randy? Okay, hearing none, we'll go to the next item on our agenda, which is to receive the actuarial valuation for fiscal year ending June 30th, 2018. Move it. Second. All in favor? Aye. Any opposed? Motion is carried. Our next item is the presentation of the investment performance review period ending September 30th, 2018, and Doug Anderson is here with us today from AMCO.
Good morning, Madam Chairperson and trustees. How is everyone today?
Great.
Good. We're going to start with the large September 30th investment performance report because it is the best news that I have. Subsequent to September 20th of this year, markets have been very volatile, including 2 days ago. They weren't volatile yesterday because they were closed, and then we've opened up with some volatility again this morning. So markets do this from time to time. If you look at the best 10 and worst 10, or 5, best 5 and worst 5 trading days over the past 11 years, you'll see that they all occurred in the fourth quarter of 2008 and 1 or 2 in the first quarter of 2009. So volatility tends to cluster, right? When markets get, I think panic is way too strong of a word, but when markets get a little edgy or anxious, then you expect to see that self-perpetuating behavior until something happens that changes the market. Now, let's be very thankful for the 400% increase in the S&P 500 from the bottom of the market in 2009, early March of 2009. So admittedly, we're starting on a very, very strong base here. Granted also that we are 10 years, right about, into a bull market, which is extraordinarily long. So we've seen some very interesting things from that period of time. And this is by no means the deepest drawdown that we've had over that period of time. There were several where we were down over 10%. And I guess the long message in all of these is that if you try to time the market, if you try to, we're going to be out of the market for a while, inevitably, when we think back on it, human behavior tells us to do that at the worst possible time. So if you have volatility clustering, right, you have the poor days, which a bad day in the stock market is not down 2%. A really bad day in the stock market is down 10%. Or go back to 87, down 25% in one day. If you decide to make a decision at that point, which would be to exit the market, history tells us that's the worst possible time to do it. And you miss the subsequent up days that tend to follow that. Now, this is market history. It could change. But this is over years and years and decades, that has proved to be the behavior of market participants, and I don't see anything that's going to be changing that significantly. Greed is always present in the market. Fear is always present in the market, and those tend to build these big moves on a day-to-day basis. The recent anxiety, well, I think that once people are sitting on big gains, I mean, I think that it's always is too good to be true. And we saw some great results in the third quarter of this year. I think that energy prices are very interesting right now. I know they affect us much more here than they do elsewhere. But you have something going on with oil prices going from the 70s to the 50s very quickly. But what you don't see as prevalent is that you've seen a very nice increase in natural gas prices, right? But the market doesn't care about natural gas. All they care about is oil. So we've seen that unbalanced. I think trade is always huge, right? And I think that I saw something recently. I discovered a new index, and this is a weird index, but it's it's put out by the Philadelphia Federal Reserve Bank, right? And it's called the Partisan Conflict Index, right? It is. I mean, because we all know this, right? You can't, I don't know if I've ever seen more awkward Thanksgiving conversations in my life, right? And it's just a fact of life that things are very, very, some people think it's overwhelmingly positive, other people think it's terribly negative. And
Polarized, I think.
Polarized is exactly right. Yeah, I was looking for binomial. I was thinking from a statistical standpoint, but polarized is exactly it, right? There's nothing in the middle, and so when things move, it goes from, firm foundation to a big gap, right? And we don't know what's going on. So I think that people are in a particularly reactionary mode right now. China is always going to be an issue, right? And when we have something we've never had before, which is negotiation by Twitter, then we're all kind of getting used to this right now. And you saw interest rates starting to move up some, right? Which, generally speaking, right, when equities go down, bond prices go up because it's a safer asset class, right? You say, I'm going to sell some of my stocks, I'm going to invest in bonds because it's sure return. But what's happened in the two drawdowns this year is that they were sparked by the bond market, right? Inflation fears make bond prices go down, right? And so inflation fears in today's market environment with a very activist Federal Reserve that's, has increased interest rates 8 times over the past 2 years is giving a very interesting message. Is the Federal Reserve going too far, too fast, and are they going to dump cold water on the economy? And so that starts in the bond market because of inflation fears, et cetera, and then that has transferred over to the equity markets. And when you start in the bond market and they start going down and the equity market starts going down at the same time, it's very unusual. We call that a correlation or causation issue. Normally, and we've seen it so far this month especially, last month, November and the early part of December, that trade has somewhat broken, right? Bond prices are starting to do better because the Federal Reserve said, we may have gotten ahead of ourselves here. And again, get back to negotiation by Twitter and what that does about it. I'm not going to be political here, but some of the rules of thumb are don't fight the Fed, right, and try to stay out of major trade issues, right? Well, we're right in the middle of both of those at the same time. But as far as the consumer, right, the consumer is the most important thing in the U.S. economy, right? 66% of dollars spent are by consumers. Housing prices, housing starts is a big part of that, so that's leveled off to down in the hot markets, right? In Oklahoma City and Tulsa and more mainstream markets, it never goes up that much, it never goes down that much. But you're seeing it at some of these marginal places with expensive housing. That's starting to soften, to roll over. But as far as mainstream consuming activity, the consumer confidence is very, very strong right now. And you would expect that, right? Employment, and again, this is a debatable figure. Unemployment in the U.S. is below 4%, right? Below 4%. There are a whole lot of people who are not counted in that figure, who could be counted in that figure if wages start to go up, which we are seeing. But you have unemployment below 4%, and you have economic growth. We had 2 quarters this year that were plus 4% in real terms, which is very, very strong. The fourth quarter of this year, the third quarter was 3.5%. The fourth quarter this year will be up between 2 and 3, most likely. So that means 2 4 plus, 1 3.5, and 1 2 plus. We're softening, right? But a lot of the activity that we saw earlier in the year was tax relief related. So that might come back again next year. But we put in a very, very strong year, very strong. And volatility, especially when you look at it from a backdrop, I tend to be an optimist, right? And a contrarian at the same time. It's tough to do that. But I think that the market overreacts on the positive and on the negative, and I think we're seeing an overshoot on the negative right now. I'm very comfortable with the investments in the portfolio. And if you look as of September 30, the results have come around very, very nicely. So given that we have several reports to go through here, and I really look forward to getting the November report to you. I think the statements just dropped last night, so we'll have those over to you fairly soon. But just a few quick mentions here on the early pages here. You'll see on page 2 of the big report, on the upper right-hand side, the quarterly performance, where we group by asset category. The top category is international equity, and you can see that's been pretty difficult. Right, the returns for international equity for the quarter ended September 30th, right? So it's July, August, September. International equities were barely positive, and emerging markets were negative. If you look below that, this is for the quarter. The blue set of columns there, the S&P 500 is up 7.7%. That's a pretty darn good year that we had in the third quarter of this year. All right, how strong those returns are. However, if you look down that list, you can see that as you got smaller companies, they tended to do worse. Remember, the S&P 500, which we have a large allocation to it, is a cap-weighted index, right? So a market capitalization is shares outstanding multiplied by share price. And that determines how big the impact of each individual company is. So as a company, share price goes up, it becomes more impactful on the return of the index. As a company's share price goes down, it decreases by that. So in a way, it turns out to be a trend-following index. The stronger companies become more and more impactful, while the weaker companies have less and less of an impact. And that helps you over the long term because you're owning more of the best performing stocks as they go up. And so it's a trend-following index. As we look in that third set of columns there on the upper right-hand side, the BBG Barclays, those are the bond indexes, so that's Bloomberg Barclays. The U.S. aggregate is like the S&P 500 of the bond world. It was flat on the quarter. The U.S. government and the TIPS indexes were both down, and you'll see the Barclays corporate investment grade of 1% rate of return. It was actually positive, right? So the higher credit risk you took during the quarter, the better your return was. And again, there's a lot of things that don't really make sense in the short term here. And one thing at the bottom there, you'll see the 3-month T-bill at 0.5% for the quarter. And if you look at you go down to the next set, or the next chart there, the 1-year performance, notice that the 3-year T-bill here is at 1.6%, and it outperformed all bond indexes over that period of time. Very unusual for if we look out the rearview mirror, right? Over the last 40 years, we have had a tremendous bull market in bonds. But now, as interest rates remain fairly low, and the Federal Reserve keeps hiking short-term rates, in many cases, and last time we did an asset allocation, we discussed this quite a lot, do we go ahead and allocate, if we're supposed to allocate 2 bonds, and we know we're going to be withdrawing that money within 6 months or a year, does it make more sense just to leave it in cash because we get almost the same return, all income, without taking any of the duration risk in that portfolio? So these are discussions that we haven't had in quite some time. The next few pages I'm not going to spend a lot of time on, just calling attention on page 3 to the enormous gap in returns between value and growth. Value stocks have been underperforming. They're a little bit more cyclical, more defensive. Growth stocks did very, very well. We've seen a reverse in that since the end of the quarter, since the volatility kicked up, and we have good exposure to both of those. I think that international stocks have been very difficult, right, not only because of slowing issues in the emerging markets. Brexit has been huge. Italy is looking at something similar to Brexit, a lot of uncertainty there, and I don't know if you've been following these riots in France, but that's certainly a disconcerting situation as well. And then China and the U.S., I don't know if it's shadow boxing, I don't know if it's negotiating tactics that are going on, but there are some fairly significant issues being spoken about there. And with this arrest of the executive from the mobile phone company in Canada yesterday, I don't know how to interpret that yet, but good thing we have active managers who are looking over this. So I think
I've
with
always
that...
heard, in response to one of Diana's questions, I've always heard that one thing the market hates more than anything is uncertainty. Yeah. And so I think that whole China shadow boxing issue could be part of the uncertainty.
Absolutely. And the one thing about that is that I think China needs us more than we need China, right? There are cheaper places to produce goods than China now. Vietnam, other Southeast Asian countries. One of the unappreciated or underappreciated issues about the fracking revolution and how we're the world's largest producer of oil now, the United States is the immense amount of petrochemical facilities that are going in on the Gulf Coast. We can produce plastic goods in the United States cheaper than in China now, right? Chinese companies are, in fact, starting to produce plastic goods in the United States for reimportation back into China. So there are ways around the inherent advantage that China has, which is very cheap labor. In fact, other means of production can compete against that right now. But again, it's not insignificant by any means, not just from a trade, but also a geopolitical issue. So that being said, and uncertainty, unfortunately, is part of our lives, right? But our view here, the biggest advantage we have as long-term investors is patience, right? When the market's going up, we should be taking profits. When the market's going down, we should be investing more in cheap assets, and that's our long-term view. When we look on page 10, you can see the trailing year total fund rate of return, 12.5%. For that 1 year ended September 30, We go to the next page, you can see on page 12, started with $5.3 million, and we're to 55 as of the end of September, and that's since 2009. Just put that in, just try to roll that math over in your head. Most of this is due to contributions, absolutely. But this pool of assets has gone from $5.3 million to $55 million over a 10-year period of time. That is fantastic growth. Even though liability is very big, this is, again, a different type of animal than a pension plan, given the cash flow of structure of the plan. Looking at the next few pages, you can see how diversified we are. Domestic equity is 65%, right? Remember, we reallocated a few years ago to be more aggressive over the long term, to invest more in equities, which are the higher returning asset category. Core fixed income at 15.6%, international equity at 9%. So we've had a relatively low allocation to international equities, which has helped us. Active duration fixed income at 7%, and then high yield fixed income at 2.7%. So we are diversified. We have different sources of return, different sources of added value within the portfolio, and not everything goes up or goes down at the same time in this portfolio, because we like to mitigate the drawdowns when those do happen. We go on page 16, financial reconciliation, where we started the quarter and where we ended the quarter. So we started at $52.7 million on the upper left-hand side. Net transfer, 0, contributions, 0, distributions. Remember that there's another cash account here that handles most of the day-to-day ins and outs. It's only when we know we have significant time with assets do we put them in this trust. Management fees are effectively 0 because these are all mutual funds, so we're not writing checks to anyone. Income was $216,000, and appreciation was $2.4 million during the quarter. So that's a very strong quarter. Again, let's be realistic with our expectations going forward. This volatility may continue for some time, and I don't expect to show you a $2.5 million gain as of the fourth quarter. But again, this is a very long-term portfolio. On page 17 shows us the total fund rate of return. For the trailing year, we already discussed that, 12.5%. What we show this against in a peer universe, in terms of peer universe, is all public plans with less than $70 million in assets under management, so the smaller plans. And this is on a net of fees basis also. So over the last 1 year, 12.5% rate of return. Our policy index would have been up 10.48. So in my mind, that is an extraordinarily good year. We beat the benchmark by over 2% in an up market. If you look at the all public plans, it would have ranked the median of that universe, the under $70 million, was 8%. And in the peer universe, our plan ranked in the 4th percentile, right? We outperformed 95% of other public funds with market value below $70 million. That's a very good year. And the last 3 years, 11.88, we're ranked in the 7th percentile, and this takes into account the period where we increase our equity allocation. So over the last 1 year and last 3 years, we've definitely seen the benefit of doing that. We go back over the last 7 years, and we go back even the last 10 years. Do recall that at the inception of this fund, we took a very cautious start. We didn't want to have a massive drawdown in some of the most uncertain market times that we've ever had. If you compare today and the uncertainty we have today compared to 2008, 2009, we weren't sure if the markets were going to open sometimes back then. And General Electric could not get a new commercial paper roll from the markets at the time when they were AAA rated. So we're in a different area. That was near apocalypse. We're having a little bit of a storm right now, not anything quite that bad. Going down the rate of return for the individual investments for the last 1 year, you can see that for the most part, our ranks are very strong. Going down for Loomis Sales Bond, they were up 1.17. Their index was down 1.22. In an actuarial sense, when we see fixed income benchmarks showing negative returns, that means interest rates are increasing, which when you're trying to discount a very long-term liability is actually good. So when we see that Loomis Sales portfolio perform well, that's great. Double line ranked in the 6th percentile, down 5 basis points. Again, the index was down 1.22. And then our high-yield bond fund, remember, these are junk bonds, below investment grade, riskiest part of the bond market, actually had the best return over the last year and the last quarter, net of fee rate of return of 2.62. The one bond portfolio that was not participating in the rally was Hoisington. This is the active duration bond portfolio, so if they think interest rates will be moving lower, they'll position the portfolio to maximally benefit from that. And you will see, and they're very long-term investors. So over the last year, they were down 4.3%. If you go back over the length of that fund, they have been very adept at doing this. And if we look at them, remember I said the bond market started the drawdowns this year, but so far this month, I would say that Hoisington is by far our best performer from November and then the few days since, because that relationship of bonds and stocks going down at the same time has reversed itself. Our index fund, you can see the Vanguard 500, 17.74% rate of return, very closely tracking its benchmark second percentile rank. Mid-cap doing a nice job also, but our mid-cap value is outperformed our index, right? Remember, we have both of these because we know it's cyclical, active versus passive performance in the mid-cap part of the marketplace. But that rate of return by Hotchkiss & Wiley went to the first percentile of the mid-cap value index, and really a star performer here is the Stevens small cap growth. We've struggled with Stevens in some of their periods of underperformance in the past, but that fund was up 37.37% for the trailing year, and that ranked in the 10th percentile, outperformed its benchmark by 16%, which is remarkable. In our Causeway International Value Fund, underperformed, but again, that's a very difficult market to invest in right now. So I don't want to go through the individual fund sheets here, but what I would like to do is I'd like to go to pages 40 as far as the compliance, the status report. No changes here. We'd like to keep Causeway on alert, given that they're underperforming slightly. No other additions to that list. On page 41, this is a very important page for us as fiduciaries. Cost monitoring and control is one of the primary duties as a fiduciary. And if we look at this, the weighted average expense ratio for the funds we invest in is 56 basis points. If we were to invest in the average fund within each of those categories, it would be 93 basis points. So that's 37 basis points to the positive, right? That's more than 1/3 off average, and we are not compromising quality to get these lower cost funds either. And that is an annual savings to the trust of almost $137,000 per year. And this is something that we need to keep in our files and keep in front of us. Now, when we look on page 42, you can see the asset allocation here, where we are allocated for all of the funds. You can see that our Stevens fund is appreciated outside of its range. We'll be checking this again with the November 30th figures this week to see if we need to make any changes. And then the following page shows returns for all of the funds for as long as we can track them, going back all the way to 2010. So that's the 930 report. We're very pleased to see the improvement, given the reallocation, the new target. We will be in a volatile environment for some time, just expect it. However, volatility on the downside is often followed up very quickly by volatility to the upside. An aside, one of my colleagues, actually in the central northern Midwest, sent an email to all the other consultants at our firm and said, I don't really know how to deal with this. I went to a client meeting, board meeting this week. The board was agitated because of the volatility, and they put a standing item on their monthly board meeting to vote on whether to go to 100% cash every month. And that's not good investor behavior, not by any means.
No mattresses were available?
No mattresses were available. But that is clearly out of the ordinary. But, you know, and it is understandable, right? I mean, you're trying to do the best for your constituents. I just don't think that, you know, that's the way to do it. I think taking a more positive outlook on how to use the time that we have, right? That's our biggest lever, is that we can be patient through these difficult periods of time and even take advantage of them because that this is a near-perpetual fund. I think that if we don't acknowledge that and work that way, then we're not doing the best that we can. So that's the full 930 report. We've got a raft of other monthly reports, I know, that we're supposed to take a look at. There was an August 30, there's a September 30. I think that if we take a look at the October report, that's the only really new information that we have. And that should be up there. Does everyone have a copy of that? It's a small one, the stapled together.
I am not seeing that. Does everybody
I did
else
not see
have
it in the
that?
packet.
The flash reports, the October 31st flash report. I don't think we have that.
Sure.
Yeah, it should be attached to this packet with just several reports. Should be on the very top.
I don't think we have it.
You guys want to pass around my copy?
No, but I know where there's a copier, and we could go have some copies made, Bob, if you want to go in the manager's office.
I can do that.
And do that. We can, if it's okay with you, Doug, we'll just defer that item for a few minutes.
Sure.
And go ahead and continue with our agenda and come back to you.
Oh, absolutely.
Okay, thank you.
Thank you.
I'm going to move to item 9, unless there are objections. And I hope you all will bear with me while I read this for the record. Item 9 is adopt joint resolution authorizing an agreement with United Healthcare of Oklahoma Incorporated, the Oklahoma City Municipal Facilities Authority, and the Oklahoma City Post-Employment Benefits Trust as the public entities contracting with United Healthcare of Oklahoma Incorporated on behalf of the City of Oklahoma City to provide a major medical health maintenance organization plan for eligible employees and retirees and eligible employees and retirees of participating public trusts, subject to annual fiscal appropriation by the Council for the City of Oklahoma City effective January 1, 2019 through December 31, 2019. Estimated year one cost, $58,302,038. And I understand Jason Long is here from the Personnel Department to make a presentation or answer questions. I'm not sure, Jason, what your intentions were.
Okay. I was here mainly to answer any questions that the trustees had in regards to any of these agenda items.
So this is a fairly routine item for us. We contract on an annual basis for this type of health care program. Are there any questions? Then I would entertain a motion.
So moved.
Second.
All in favor?
Aye.
Any opposed? That is approved. And Jason, if you'll give us just a minute, we'll go back to Mr. Anderson,
Okay.
and then we'll get to the rest of yours.
Okay. Thank you.
Doug, I think we all have the flash report in front of us now, hopefully, at least for October 31st.
So Doug, I'm just, you know, amazed by the returns. I've been focused and fixated on page 5 of this booklet, and I'm looking at some of these one-year returns. Yeah, this is just while you were setting up to.
The September 30 report?
Yes.
Yeah, it's been amazing.
Yeah.
And you know, it's
Unbelievable.
unusual to see returns that strong this deep into a market, right? But then if you trace back, what I didn't say when I was talking about economic growth of 4%, 3% this year, is how weak it's been in the recovery. I mean, if you look at most economic recoveries, they tend to accelerate at the very beginning and then taper off over time. This one's been very low, and it's only accelerated recently. And that's been it's been reflected in the returns. And sorry about not having the October 31, the 3 monthly flash reports that we were supposed to go over this time. October is the worst of the 3. Again, we'll expect to see November, some positive, some negative in it. It's too early to tell. But if you look at this rate of return, we went back to $55.5 million at the end of the month. The 1-month rate of return was negative 668, and some of our active investments were the ones that went down the most. International equities were hurt badly. Small cap growth was hurt. It was down 11.77. You still look at the 1-year rate of return on that, and it's still 18.6, but still 11% loss in 1 month is not comfortable. It doesn't feel good. The Hotchkiss and Wiley portfolio, and this is again why I said we're going to take a look at the 11/30 numbers for reallocation before we do anything. And then looking at the others here, the S&P 500 down 686. The high yield did trade off, and you'll even see the Hoisington was down this month for the month of October. But like I said, November has seen interest rates on a 30-year Treasury go from 3.4 down to about 3.11 as of today. And if you multiply that difference times a duration of about 18 years, you can see that the return on the Hoisington portfolio is going to be very strong. And that's one of the reasons that we have them with a 8% allocation, is because if markets work, having this in the portfolio reduces the drawdown when equity markets trade off. It's a hedge to equity market volatility. So no major issues with any of the firms here. I didn't mention it for the other report, but all the firms are very strong. They're doing very well. Vanguard is the go-to index provider out there. And again, you may have heard that Fidelity is now offering free index funds. That does not apply to us. It only applies to individual accounts for new accounts being opened up at Fidelity. So it's not something that applies to us here. Although we watch index prices everywhere. They're very cheap and getting cheaper. So I'm happy to answer any questions for the month of October.
Are there any questions? Okay, so this is kind of a procedural thing, and Bob, I'm probably talking to you. We're going to vote in just a minute on receiving the quarterly investment report as of September 30th. Then the next item is to receive the reports, the flash reports, for 3 different periods. And we only have one of those periods in front of us. We will only be able to vote on one of those unless somebody wants to go make copies while we're still considering this. And I don't know how important that is to you, but okay. All right. Right, so one of those is the item number 6, and one of those, the October, is in the item number 7. But only one of those in item number 7 is present. So I will entertain a motion on item 6, receive quarterly investment performance report for period ending September 30th, 2018. All in favor? Aye. Any opposed? Motion carries. The next item is to receive the monthly investment flash report as of October 31st, 2018. Move it. Any, all in favor? Aye. Any opposed? What is it about me? I always want to ask if anyone's opposed before I ask if anyone's in favor. Must have a negative outlook. That's a negative outlook for you.
Possibly
okay.
Realistic.
Yeah, possibly. Thank you, Doug, for your presentations.
Thank you.
The next item is discussion and consider approval of additional asset allocation or changes to portfolio fund managers as recommended by the board or the investment consultant. I'll open that item. I didn't hear any recommendations from our investment consultant, but if the board wants to have a discussion about that. Okay. What do we need to do on that? Just nothing?
No action.
No action taken. Got it. We can do that. We're good at that. The next item, since we've done number 9, is number 10. Adopt a joint resolution approving an administrative services agreement and group term life insurance plan with Dearborn National Life Insurance Company to provide a group term life insurance plan and administration to city employees, retirees, and employees and retirees of participating public trusts, subject to annual fiscal appropriation by the council for the city of Oklahoma City, effective January 1, 2019 through December 31, 2023. I'll entertain a motion. Are there any questions for staff? Anyone all in favor? Any opposed? Okay. Our next item is item 11. Adopt a joint resolution authorizing renewal of modified administrative services agreement with Blue Cross and Blue Shield of Oklahoma, a division of Healthcare Services Corporation, a mutual legal reserve company on behalf of the City of Oklahoma City for eligible employees and retirees and eligible employees and retirees of participating public trusts, subject to annual fiscal appropriation by the Council for the City of Oklahoma City. Estimated cost $36,337,162, effective January 1, 2019 through December 31, 2019. Also a routine item. Jason is available to answer any questions.
Move the item. Second.
All in favor?
Aye.
Any opposed? Item number 12. Adopt a joint resolution authorizing renewal of a modified administrative services agreement with Blue Cross and Blue Shield of Oklahoma, a division of Healthcare Service Corporation, a mutual legal reserve company, the Oklahoma City Municipal Facilities Authority, and the Oklahoma City Post-Employment Benefits Trust as the entities contracting with Blue Cross and Blue Shield of Oklahoma on behalf of the City of Oklahoma City to provide a group dental plan for eligible employees and retirees of participating public trusts, subject to an annual fiscal appropriation by the Council for the City of Oklahoma City. Estimated cost $3,500,000, effective January 1, 2019 through December 31, 2019. I'll entertain a motion.
Move the item. Second.
All in favor?
Aye.
Any opposed? Okay, our next item, Lucky 13, is the acceptance of the interim financial statements for the 3 months ended September 30th, 2018. Rhonda Dugan from our Accounting Services Division is here.
Good morning. First, I would like to direct your attention to page 6, the statement of net changes in net planned net position. At September 30th, the trust reported net position of $61.9 million. This is an increase of $3.7 million over the June 30th, 2018 net position of $58.1 million. In comparison, the trust gained $2.2 million in net position in the prior year, first quarter. Contributing to the increase is increase in employee contributions of $57,000, an increase in investment income of $823,000, and a decrease in total deductions of $828,000 in the first 3 months of FY19, as related to the same 3 months in FY18. In addition to those notable changes, investments increased $3 million, with the largest gain in domestic common stock of $2.4 million. Now I direct your attention to page 10, starting on page 10, under deposits and investments. At the bottom of page 10, under money markets, used to pay claims are reporting at $7.1 million compared to the prior year of $27,000, which is reported at the top of page 11. On page 12, in our asset allocation guidelines.
Rhonda, could you said that, I'm sorry, I missed that. You said that, what are we talking about on page 10?
Page 10 was the money markets. They were, if you look at the money markets, it was 7.1 million.
Right.
That is an increase over the money markets in the prior year of 27,000. That's up on the top of page 11.
Okay. Quite an increase.
Yeah. And then on page 12, under the asset allocation percentages, fixed income securities reported at 27%, leaving the remaining 73% for equities. last meeting, I think there was a request for a summary of the percentage of funded, the funding percentage, and I had passed that out to everyone prior to the start of the meeting. It's a 6-year comparison, starting with GASB 45 numbers, changing to GASB 74 in FY17. If there's any questions I can answer.
Are there any questions for Rhonda? Hearing none, I'll entertain a motion on accepting the financial statements for the period ending September 30th, 2018.
Move it. Second.
All in favor?
Aye.
Any opposed? Our next item is to receive the schedule of regular meetings for calendar year 2019. This is also routine. Francis, do you have any comments on that? Since you're the meeting queen?
No, Ms. Vice Chairman, this is the same schedule we adhered to in 2018.
Okay.
Plan 2019. It's on the back of the financial statements.
I'd like to commend the Treasury Office for their excellent conservation of paper resources. Yeah. So our meetings will be on February 11th, May 13th, and August 12th, and November 18th of 2019.
Move the item.
All in favor?
Aye.
Any opposed? Our next item is to ratify the claims listing.
Move it.
All in favor?
Aye.
Any opposed? Our next item is reports, comments from trustees, staff, and interested parties. Staff, you have any comments? Nope. Trustees? Diana, no comments? Who are you? Okay. That's right. Hearing no other business, we are adjourned.